With the recent Bank of Canada's announcement in the last couple of months going down, down, and down again, it's got more Canadians asking themselves the question for the first time in a long time, is a variable rate mortgage the right move? And no, I'm not gonna make you wait until the middle of the video, but I am gonna start off with a couple of pieces of detail and facts that you need to know to preface by getting into this video and conversation. Now, if you're watching this video, you're probably someone who's either thinking about getting a mortgage, whether you're looking to renew, refinance, or purchase. And you're gonna have a few different decisions to make. First and foremost, clearly, let's define the difference. A fixed rate mortgage is one that remains the same for the entire length of the term, whether it be 1, 2, 3, 4, 5, 7, or 10 years, and a variable rate mortgage can fluctuate based on prime. There's two different types of variable rate mortgage options. One is an adjustable rate. That's where payments decline based on the market going down, right? The Bank of Canada reduces interest rate, prime goes down, your payment goes down along with that because the interest amount is going down. Or there's the second one, which has been in the news for the last couple of years, which is a fixed payment variable rate. We call it a VRM. You can hear it called a fixed payment, frozen payment. There are other terms out there, but most of the big banks actually offer these options. And in these situations, the amount that you pay to interest and principal actually changes, but the payment itself remains the same unless you reach out to the bank, and in some situations, the bank will allow you to reduce the payment or change the payment based on there being the same amortization upheld on the term. So now that you know the difference between the two, in a declining rate environment, people are asking the question, even knowing that variable rates are still higher than fixed rates, what makes the most sense and why the heck would people even think about a variable rate mortgage in the first place? So let's rewind to where we are right now and why variable rates have been vilified for the better part of the last year. If you have been hiding somewhere or you just moved to Canada, you would know that the Bank of Canada raised the overnight rate over 4% over the course of literally a year, which made variable rates go from essentially 1 or 1.5% in some situations all the way up to the 6% range for a lot of families. That was dramatic, and it had a very significant impact on a lot of families' lives and their ability to make their monthly payments or just see their actual mortgage pay down. So is it almost crazy to think that people would actually be jumping back into the variable rate water so quickly after they decided that it wasn't something they wanted to do? No, and in fact, it's not crazy at all, because just like things go up, they can go back down. Now, I'm not suggesting that the BOC is going to reduce overnight rates to 0.25% like we saw during the COVID times, but there's no doubt that we're going to be seeing rates come down if for no other reason that they need to stimulate the economy and keep it stimulated. And not to get too focused onto where the economy is right now, but if you don't know this already, the Bank of Canada typically lowers rates to stimulate the economy and increases rates to cool down an exceptionally hot economy, which is why we are where we are at today. And with the last few quarters seeing GDP in our country, essentially our productivity in the country of Canada completely drop off the map, they have no choice but to look to lower interest rates. That plus businesses going bankrupt, plus people having no money. Well, the Bank of Canada has to lower interest rates, and that makes it interesting for someone who's making a decision on a mortgage today, again, looking at the two options. Now, if you're looking at a fixed rate and a variable rate today, the crazy thing is you're gonna be looking at a fixed rate, which is lower than a variable rate, typically by about 0.75%. And we're gonna pull up an exact scenario to walk you through how to make a decision today based on a very conservative outlook. Remember, it's hard enough for us to see 3 months ahead, let alone 3 years ahead, but we're gonna use the forward markets, which is an amalgamation of a bunch of economists making their best decision on what could happen in rates to make our decisions today. So let's get into it. All right, so here's an example of a real life scenario that we're looking at with a $500,000 starting balance on a mortgage, a 25-year amortization. We're looking at a variable rate versus a fixed rate mortgage, 5-year to 5-year, to make things pretty simple. When we're looking at these options, one factor to consider is the compounding schedule. Now, some variable rates are a 12-month compounding schedule, others are twice a year, so semi-annual. So if we're looking at the two options here, we need to compare apples to apples and make sure we're choosing the right term. We're gonna use a semi-annual variable rate so we can compare them directly. Now, we're gonna look at the Bank of Canada's overnight rate being at 5.95% for prime. At this point right now, we are going to look at a 0.75% rate reduction over the course of the next couple of years. But we're gonna make things even and suggest that by the end of 3 years, in October of 2027, we see a 0.25 point increase, and followed by another quarter point increase towards the end of the term. Now you can play with the numbers any way you like, but that's what we're going to use today. Now we're also assuming this is an uninsured mortgage or an insurable mortgage where you're not paying for the additional insurance for your mortgage. And in doing so, you're going to look at a fixed rate of 4.49%, which is readily available in the marketplace, as well as a variable rate of prime minus 85. You could be a little bit higher or a little bit lower, but we don't want to assume those terms because they can change. And these are readily available rates for most qualified Canadians at this time right now. Now, if you're looking at your different rate options available to you, you can see that the rates start at 5.95% prime and continue to work their way back down. As you can see, we have the interest rate, payment, principals, and of course, at the end of the day, it'll average out at the very bottom, total cost of payments and so forth. So let's get right up into the goods and talk about what the numbers look like. The average payment over 5 years on the variable rate 5-year term is $2,654 with an average interest rate of 4.14. Whereas on the 5-year fixed, well, the rate is the 4.49% and the monthly payment is $2,763. So who wins in the face-off at the end of the day? At this point right now, it is the variable rate mortgage. So there are other variables that you can look at, such as what if the BOC decides to reduce rates even faster? If the rate changes go down, then these numbers go up. And if it's the opposite, then of course, the amount of money that you save over the term is less. And so how is this advantageous when you consider the possibility of locking in at low 4.5% or similar interest rate? Well, the answer to that question really comes down to specifically knowing you and your situation. You see, there's another factor to consider, which is two things. Number one, you have the option to lock in a variable rate at a later time. Now, there's many who believe that fixed rates have reached their bottom, but there are also many that suggest that they've reached their bottom for now, but they could be coming down in the future. And if you believe that fixed rates will continue to come back down, then this hypothesis makes a lot of sense because you could choose to lock in at a later time at a lower potential interest rate and have a much lower total cost savings while protecting yourself. The second consideration here is that we might see the Bank of Canada lower rates even more, and that could work in your favor as well. And the third consideration is, well, at the end of the day, none of us knows what's going to happen. And if you break your mortgage early, if you go into a variable rate mortgage, you know that you have essentially penalty protection and you only ever have to pay 3 months worth of interest versus an IRD penalty with a fixed rate mortgage, which we are starting to see already happen for people who bought their homes just a year and a half ago, where they are now seeing interest rate differential penalties. And on $500,000, you could be paying as much as $25,000 to get out of that mortgage right now. So here's a few things that you need to think about before making this decision on the fixed or variable. Number one, you should be doing a rate analysis with whichever rate that you actually are offered. Number two, you need to think about the strategy mid to long term. What's the likelihood that you can sell your house, break your mortgage, pull out equity, refinance? Number three, how do you feel if you were to lose out on potential interest savings? So for example, if interest rates were to go down, would that bother you if you couldn't have locked in at that time? Number four, if you do decide to go variable, do you know the terms of your lender in terms of the lock-in? There's 30, 40 different lenders that you could choose on a regular basis, and they all have different lock-in terms. Do you know how to negotiate those? And do you know what it's going to cost you if you break it? Because that 3 months of interest is based on something different with different lending institutions. Essentially, in any of these circumstances, you need to be able to understand your personal circumstance first, your risk profile second, and then hopefully get educated advice so that you make the right decision when it comes to a fixed or a variable rate mortgage. If you found this impactful, we create an amortization schedule for every one of our clients that we are working with in the process. We'd be happy to work with you. Just click the link in the bio below and be happy to prepare one for you today.